The truth about capital works, depreciation, and capital gains tax. How does it work? Well, there are two primary divisions that allow investors to claim depreciation on their asset: capital works and plant and equipment. Capital works refer to the building's wear and tear on mostly structural components. Things like roofs, floors, tiling, cabinets, electrical cabling and the like all deteriorate over time, and their drop in value can be used as a tax deduction. You can also claim depreciation deductions for removable or transferable plant and equipment assets within your property. These are things like air conditioners, blinds, light shades and the like. If the property is sold, a gain or loss is computed separately for such items. But capital works deductions also decrease the cost base of your property, which means there will be a higher taxable amount as a capital gain when the property is sold. Say you make $100,000 capital gain in 2 years. If over those 2 years you also claimed $10,000 in capital works depreciation for tax purposes, then the ATO views that sale as a $110,000 capital gain. Now, some would argue, what's the point in claiming depreciation deductions if you're only going to have to recognise them in your CGT liability when you sell? So that begs the question, is capital works depreciation worth it? Well, there are some important elements that make claiming depreciation lucrative for investors regardless of CGT. Firstly, you're not paying all of that capital gain back to the ATO if you've owned the property for 12 months or more. Under those conditions, you'll get a 50% CGT exemption, so straight away the CGT impost for claim depreciation is cut in half. Secondly, most people try to retain their property for a price cycle of at least 10 to 14 years, and some much, much more. Time decreases the value of a dollar. $1 will buy more now than it will in the future. Given this economic truism, the benefit you get from claiming, say, $10,000 in years 1 or 2 of ownership versus the cost of repaying part of that claim in the form of CGT in 15 years is dramatic. In short, you will still be way ahead and the benefits grow proportionate to your years of ownership. Thirdly, investors are most often in an accumulation or growth phase during the first few years of owning an asset. During that time, they are looking to maximize their cash flow. This helps cover their holding costs, including interest, maintenance, management fees, and the like. It also assists when sourcing finance. It's important to get these benefits early because in subsequent years, you'll pay down your mortgage. In addition, your rents hopefully will rise. This means the further you progress along your portfolio ownership, the easier it should get to cover holding costs or even proceed to a cash flow positive property. Ask any experienced investors. It's better to be paying a little more CGT when you sell in the distant future than struggle to get a loan or pay your bills early in the piece. So what are you waiting for? Depreciation delivers benefits today that result in a reasonably pleasant problem for you in the future. How to deal with the extraordinary gains you've made through the long term in property investing.